The quantitative easing that has been seen overseas might be beneficial to aiding economic growth, but it's having a terrible effect on pension funds' liabilities. This has left many pension schemes underfunded in the developed world. So are South Africa's pension schemes facing the same problem? As a consultant to many of the country's largest pension schemes, Fahmida Peterson-Lurie is well positioned to answer this question. Thanks for joining us, Fahmida. We just wanted to get a sense and a contrast with respect to the state that our local pension schemes are in with regards to meeting their liabilities of their pensioners, and just measure that against what we're seeing overseas with many of the large pension schemes of both private and public bodies being underfunded in terms of their liability.
Mm-hmm. Thanks, Warren. Yeah, the problem of particularly large international pension funds being underfunded has been around for quite a while, basically since the start of the global financial crisis. And South African pension funds have very fortunately been in quite a different position in terms of actually having been in positions of surplus at the start of the early 2000s, and legislation having come into place in South Africa where they actually needed to apportion out some of those surpluses. And obviously, to safeguard the funds went and established quite strong valuation bases so that they didn't end up paying away surpluses and then find themselves in a deficit sort of a few years later because of bad financial conditions. So South African pension funds did tend to have the reserves they needed to protect themselves. Of course, what we have seen in the last 4 or 5 years has been an unprecedented time of market turmoil. So retirement funds have needed to be a lot more dynamic in the management of their pension fund assets relative to their pension fund liabilities. And we've also seen the South African legislation around pension fund investing change, which was probably something, well, it was in process since the late 1990s, in fact, but the timing has been quite prescient in terms of when it actually came into play. I think
you're probably referring to some of the changes mentioned in Regulation 28 there. Just in terms of that, we knew that there needed to be an update in that regulation. Has the Regulation 28, as it now sits in the revised format, given pension fund managers and investment managers the ability to invest in a manner that would allow them the flexibility to meet those targets?
Absolutely. The new Regulation 28, and its descriptive heading is actually spreading of assets. So its descriptive title is spreading of assets. It tries to force pension funds to invest their assets cognizant of their liabilities. So for defined benefit funds, it essentially establishes a requirement to do an asset liability modeling for the pension fund to say, well, these are the benefit expectations and the benefit promises you make to your members, sometimes as much as sort of 40, 50, 60 years out, if you think of a young 20-year-old still getting his pension at the age of 80. And then actually saying, so let those benefit promises, which typically are linked to inflation, sometimes salary inflation, sometimes just inflation, let those benefit promises actually define where you go and invest. So a defined benefit fund would then, if they've got a young workforce and they've got pensioners who they're paying CPI increases to, would go and invest in your real assets as a result of matching to that. And then more mature pension funds, and there are quite a few of these DB funds around, actually have to invest sort of more short-term into more short-term assets where they can't take a lot of volatility in their asset values. And Regulation 28 is now driving that sort of holistic asset class strategy that the pension funds actually need to follow on the DB side. And then on the DC side, defined contribution funds, right, they have to take a similar consideration. If they've got lots of older members who are heading close to retirement, they can't have the bulk of their assets in equity markets, which could be down for 3, 4, 5 years. They actually go and invest a lot of their assets into bonds and inflation-linked bonds, into property, things that have more stable values but will still give you reasonable returns. And then defined contribution funds of very young companies where, you know, the bulk of their members are in their 30s and they're 30 odd years from retirement and actually needing to take their cash, will invest in more equity aggressive strategies. And then, in fact, you'll find what many funds have been doing over the last sort of 5, 10 years, but is now again reinforced with Regulation 28, is they have different pots of money, effectively different portfolios that different memberships can participate in depending on their age to retirement.
Right.
Yeah.
Now, just in terms of, we mentioned the quantitative easing and some of the problems it's causing. Are you seeing any dislocation and any effects it's having in South Africa? Although we haven't gone through quantitative easing as such, we're feeling some of the brunts of that with the large amounts of capital leaving developed markets.
Absolutely. I mean, if you look at the behavior of the South African stock market, for example, over the last, what is it, 18 months, I mean, you see the risk on, risk off effect of money coming into the country and leaving the country. But because of this flood of money, for example, in the US, where you've had the massive quantitative easing, that monies are looking for assets to invest in, so they've come and invested in South Africa, and they're obviously investing in South Africa on momentum. Lots of risk on risk of money invests sort of following the momentum theme, and so they've driven the FINDI up dramatically in South Africa over the last 18 months, and we've seen the divergence as a result between the FINDI and the resources, because these momentum investors are investing into the stocks that are escalating in value. And then we've had a similar effect on the bond side, compounded by the inclusion of the South African bonds in the City Index last year. And so, I mean, last year we just saw the bond yields breaking new limits all the time, as particularly inflation-linked bonds, the yields just kept on going down because of the demand that we're seeing for the South African bonds.
So it's actually caused a bit of an artificial bubble in some respects.
Absolutely.
And we've seen, and we speak to a lot of investment managers on the show, but they've been seeing more and more opportunities offshore. Is that something that you've been encouraging your clients to do as well, is to consider that offshore component more seriously?
Absolutely. So Regulation 28, the revised Regulation 28, increased the offshore investing limit to 25%, which meant that pension funds could in any event go and take more money offshore, subject to the legal and regulatory process. And what we're seeing now is South African equities, and in fact it's been the case probably for the last year, where South African equities have been a lot more expensive than international equities, both developed and developing markets. And so you've had pension funds wanting to go offshore anyway because they've got a big allowance and they want the rand hedge, etc., with holding dollar currency. Obviously now being allowed to do that because of the higher allocation through Regulation 28, and again it's been the sweet spot in terms of timing, or in terms of relative value. So lots of pension funds are looking at going offshore, developed markets and emerging markets, into equity. At one stage last year there were, and in fact in 2011 as well, there was a significant allocation to your high credit risk assets, because they were giving fantastic yields. We've seen that come in quite a bit over the last sort of 6 months. So some funds have been decreasing their allocation, where they actually make an explicit allocation to high yield bonds. But we're still seeing a lot of funds absolutely maxing out their offshore limit. I mean, as another example, not subject to Regulation 28, but Government Employees Pension Fund has even gone and taken a significant amount of money offshore in the last 18 months to make use of that disconnect that you're effectively seeing between South African equity pricing and international equity pricing. And then Regulation 28 also now obviously allows you to take a further 5% onto the African continent. And so notwithstanding sort of all the glitches you have with investing in Africa and the liquidity problems, and I mean their markets are incredibly volatile, you've seen more and more pension funds showing some interest in actually investing in Africa, and we've seen some of the bigger managers launch products in that space.